Hello everyone, welcome to today's lecture. In this video, we will study agency problems and corporate governance. This topic is one of the most important ideas in corporate finance because firms do not make decisions by themselves. People make decisions. Managers choose projects. Creditors provide financing. Shareholders expect value creation. Employees depend on stability, and customers expect quality and trust. A company may have a very clear objective, such as creating long-term value or maintaining financial strength. But the objective alone is not enough. The real question is whether the people who control resources have incentives to act in the best interest of the people affected by their decisions. An agency problem appears when one party makes decisions on behalf of another party, but the decision maker's incentives are not perfectly aligned with the interests of the party being represented. So, today, think of governance as the system that helps answer a simple but powerful finance question. Are decisions being made responsibly, transparently, and in the long-term interest of the firm? Let's begin with the agency relationship. An agency relationship exists when one party, called the principal, gives decision-making authority to another party, called the agent. The agent is expected to act on behalf of the principal. In a corporation, this happens everywhere. Shareholders provide equity capital, but managers run the business. The board of directors oversees executives, but executives control daily information and operations. Creditors lend money, but they do not manage the firm after the loan is made. Employees and customers also depend on managerial decisions, even though they usually cannot see all the internal information behind those decisions. This delegation is useful. A modern corporation could not function if every shareholder, creditor, employee, and customer had to approve every operating decision. Delegation allows speed, expertise, and efficiency. But delegation creates two major problems. First, incentives may conflict. The agent may benefit personally from choices that do not maximize value for the principal. Second, information is unequal. The agent may know more than the principal about the firm's real condition, risks, and opportunities. That combination, delegated authority, imperfect monitoring, and misaligned incentives, is where agency problems begin. Now, let's look inside the firm and see where these conflicts appear. The classic corporate finance conflict is between shareholders and managers. Shareholders own the residual claim. That means after creditors and other obligations are paid, shareholders benefit from the remaining value. Managers, however, control many of the decisions that determine whether that value is created or destroyed. In principle, managers should choose strategies, investments, financing policies, and operating plans that increase long-term firm value. In practice, managers may face incentives that pull them in other directions. For example, managers may prefer excessive growth because a larger company can bring more prestige, power, and compensation. They may enjoy personal perks, such as expensive travel or privileges paid for by the firm. They may resist changes that threaten their position, even when those changes would benefit the company. Managers may also become too focused on short-term earnings, bonus targets, or stock price reactions. Sometimes they avoid valuable risky projects because failure could hurt their careers. Other times, they may take excessive risks because the rewards are personal while some losses fall on others. The point is not that managers are always unethical. The point is that incentives matter. A particularly important shareholder-manager issue involves free cash flow and managerial discretion. Free cash flow means the firm has cash beyond what it needs for its best investment opportunities. Cash is useful. It can help a firm invest, reduce debt, handle uncertainty, and maintain flexibility. But extra cash also gives managers more discretion. When managers have large amounts of available cash, they can use it wisely or poorly. They may invest in valuable projects, strengthen the balance sheet, or return cash to owners through dividends or repurchases. But they may also fund low-return projects, expand simply for size, or pursue acquisitions that look exciting but do not create enough value. This is why finance is not only about calculating whether cash exists, it is about asking how cash will be used, who controls it, and what governance process evaluates the decision. A disciplined firm does not treat every expansion as progress. It asks whether the investment creates value after considering risk, opportunity cost, and long-term strategy. So the issue is not whether cash is good or bad. The issue is whether governance encourages disciplined capital allocation. Agency problems also arise between shareholders and creditors. Creditors lend money with the expectation that the firm will pay interest and repay principal. Shareholders benefit from the upside after creditors are paid, but shareholders also have limited liability. This difference can create incentives to shift risk toward creditors. One common conflict is asset substitution. After borrowing money, the firm may choose riskier projects than creditors expected. If the project succeeds, shareholders receive much of the upside. If it fails, creditors may bear part of the loss because the firm's repayment ability declines. Another conflict is underinvestment. A highly leveraged firm may reject a positive value project if most of the benefit would make existing debt safer rather than increase shareholder value. There can also be claim dilution, where new debt reduces protection for existing creditors, and excessive payout, where cash is distributed to shareholders while creditors are left with fewer resources supporting repayment. This is why debt agreements often include covenants. A covenant is a condition in a borrowing agreement. It may limit total debt, restrict dividends, require minimum interest coverage, require financial reporting, or protect collateral. Covenants are a governance tool. They reduce creditor risk, but they must be balanced against the firm's need for flexibility. Agency conflicts are not limited to shareholders and creditors. Financial decisions affect many other stakeholders, including employees, customers, suppliers, communities, regulators, and even the environment. A decision that improves short-term numbers may create hidden long-term costs. For instance, managers may reduce employee training to increase current earnings, but that can weaken future capability. They may delay maintenance to save cash, but that may increase safety or reliability risk. They may pressure suppliers for short-term savings, but that can reduce quality or weaken the supply chain. Managers may also underinvest in compliance, cybersecurity, product safety, or environmental controls because the benefits are less visible immediately. But later, the firm may face lawsuits, reputational damage, customer loss, regulatory penalties, or operational disruption. This is where agency problems become ethical problems. When managers control information or resources for others, trust becomes central. Good governance is not only about obeying technical rules, it is also about honest communication, responsible incentives, reliable reporting, and accountability for consequences. In finance, ethical behavior and value creation are connected. A firm that repeatedly breaks trust eventually pays for it. Agency problems create costs, and we call these agency costs. There are three broad categories. The first is monitoring cost. These are costs paid by principals to observe, evaluate, or restrict agent behavior. Examples include audits, board oversight, internal controls, performance reviews, disclosure systems, credit monitoring, and compliance processes. The second is bonding cost. These are costs paid by agents to reassure principals that they will behave appropriately. Examples include contractual promises, reporting commitments, clawback provisions, performance guarantees, or restrictions accepted in advance. The third is residual loss. Even after monitoring and bonding, the agent's decisions may still differ from what the principal would prefer. That remaining value loss is residual loss. A simple way to remember the idea is this: agency cost equals monitoring cost plus bonding cost plus residual loss. But here is the important lesson. The goal of governance is not to eliminate every agency cost. That would usually be impossible or too expensive. Instead, effective governance asks, how much oversight is enough to protect the firm without slowing every decision, discouraging initiative, or creating unnecessary bureaucracy? Good governance balances control and flexibility. Now we can define corporate governance in a practical way. Corporate governance is the system of rules, processes, relationships, and incentives through which a firm is directed and controlled. It determines who has decision rights, who monitors performance, how managers are compensated, how information is disclosed, and how conflicts of interest are handled. Governance mechanisms can be internal or external. Internal governance comes from inside the firm. It includes the board of directors, executive compensation, internal controls, audits, budgeting processes, risk management systems, and ethical culture. External governance comes from outside the firm. It includes capital markets, creditors, regulators, analysts, rating agencies, auditors, customers, competitors, and the market for corporate control. One of the most important internal mechanisms is the board of directors. The board does not manage every daily decision. An effective board selects and evaluates the chief executive officer, reviews major strategic and financial decisions, oversees risk management, monitors financial reporting, protects against conflicts of interest, and supports ethical standards. Large firms often use committees. The Audit Committee focuses on reporting and controls. The Compensation Committee focuses on executive pay. Governance and risk committees improve focus, expertise, and accountability. Executive compensation is another major governance tool because pay affects behavior. If managers are rewarded only for short-term accounting earnings, they may underinvest in long-term projects, delay necessary expenses, or make results look better temporarily. If managers are rewarded only for growth, they may expand without enough attention to profitability, risk, or return on invested capital. Compensation can include salary, annual bonus, stock options, restricted stock, performance shares, retirement benefits, and other forms of pay. Each component creates incentives. A good compensation plan encourages long-term value creation while discouraging manipulation, excessive risk-taking, and short-term thinking. The design must ask which measures matter, how much pay should be fixed versus performance-based, and over what time horizon performance should be evaluated. Stock options are especially interesting. Options can motivate managers to increase firm value because they become more valuable when the stock price rises. But options can also encourage risk-taking because upside gains are attractive, while downside losses may be limited. Governance also depends on information quality. Financial statements, external audits, internal controls, risk disclosures, management discussion, and board reporting reduce information asymmetry. Transparency builds trust, and trust affects access to capital, financing costs, valuation, and firm value. External governance creates discipline from outside the firm. Capital markets may respond when investors lose confidence. Credit markets may charge higher interest rates, require collateral, or restrict borrowing. Analysts, rating agencies, regulators, customers, suppliers, employees, and competitors can all affect the firm's reputation and opportunities. The market for corporate control is another external force. If a firm is poorly managed, outside investors or acquirers may believe the assets could be used better. The possibility of takeover or restructuring can discipline managers. However, it can also create pressure to focus too much on short-term stock price. So governance must evaluate both benefits and costs. Governance matters for every major financial decision. In capital budgeting, it helps prevent projects based on prestige rather than value. In capital structure, it helps monitor leverage. In payout policy, it helps balance cash returns with future needs. In mergers, risk management, and financial reporting, it supports disciplined analysis and accountability. Warning signs of governance failure include weak boards, short-term compensation, unreliable reporting, excessive power concentration, hidden conflicts, aggressive growth with high debt, and cultures where employees are afraid to report problems. Good governance asks one final question. Are today's decisions building durable value or simply pushing problems into the future? Thank you for listening, and I'll see you in the next video.